Now the value of the building, instead of 1 crore, today I have revalued it to 10 crores. 10 lakhs to 1 crore. So now, and something is there in the credit. Something is there in the debit. So I have my plant and machinery at say 10 crores. I had revalued from 1 crore to 10 crores. Corresponding 9 crore is lying in revaluation reserve. Now year after year I do not transfer. Maybe the value of machinery will come down to 1 crore. Revaluation reserve will still remain at 9 crores. So an anomaly will be there. They still have given the option that you need not charge you need not transfer year after year from general reserve to from revaluation to general reserve. In the year of sale, you can choose the option to transfer from revaluation to general reserve. This option is also given in the application guide. Even earlier, our that statement issued by Institute of Chartered Accountants, guidance note issued by Institute of Chartered Accountants of India permitted that. That if you earlier, under the old law, if you wanted that I want to charge entire amount of depreciation including revaluation to profit and loss account, you were permitted to do. Then they stated that instead of year in year, you can charge in the year of sale of the asset from revaluation to general reserve.
Sir, when the useful life of the asset should be over, then can it be treated as free reserve?
If the useful life, how can it be treated? Because revaluation reserve is a capital reserve by nature.
But the asset doesn't exist.
Still, if the asset does not exist, then you have to compulsorily charge from revaluation to general reserve. Then that revaluation reserve cannot retain in your financial statement. The question, that is the question ma'am asked. Whether it will be revaluation reserve, whether it will be a free reserve. I doubt it will be a free reserve. Say in case of demerger, there was a company with a capital of say 1 crore with a reserves of 20 crores. This company then it has two divisions. One, say your vehicle division, one investment division. Capital of 1 crores, free reserves of 10 crores. Vehicle division, investment division. I transferred a division having assets valued at 2 crores from this company to another company. So another company is formed again with a net worth of 2 crores, and say I choose to have a capital of 10 crores. Then 1 crore 90 lakhs will be I choose to have a capital of 10 lakhs. So 1 crore 90 will be your reserves. And this, what I did while accounting, I reduced the balance in the main company, 1 crore 90 lakhs out of its general reserve, and I created a general reserve in my books of accounts. So I have divided this company into two parts. Now I have a general reserve. This general reserve has come from the parent company, from the main company, that was realized in cash. If I literally interpret to subsection 43, it says that you can declare dividend only out of free reserve. So can I say it is a free reserve? I have not done. That company has done. So there is a debate on this also, whether this reserve can also be created. So there is a doubt. Unless ministry clarifies, I think there is a big doubt, big amount of ambiguity in this law, whether it can be constituted as a free reserve.
So,
No. On account of devaluation, you will not get. Earlier we used to get, I think 10 years back, when we had 115J, many companies revalued their assets and got no MAT benefit. You will not get any MAT benefit. So we had a lot of issues under Schedule 14. Now just try to can higher rates of depreciation be charged. Now we come to this new law, Schedule 2. Under old law, they said that higher rates of depreciation can be charged. Even under the new law, Schedule 2, you can charge higher rates of depreciation, provided it is followed by technical advice. Can SLM rates be different from those charged under Schedule 14? Yes, even under the new law, you are permitted. Whether it is necessary to provide for depreciation in respect of immovable property acquired for investment purpose. I have a company, I purchased a flat. I let out the flat on rent. Income is offered for taxation under the head income from house property. I do not get the benefit of depreciation under income tax while computing my total income, because I have to offer entire amount as income from house property. Right? So I do not get any benefit under the income head. We get a benefit of municipal tax, interest, and a statutory deduction of 30%. So will I charge depreciation on this investment property, on this immovable property? In my view, yes. We have a long back clarification issued by the ministry that if assets are acquired for investment, they are nothing but fixed assets and depreciation needs to be charged on that. Whether different methods can be followed for different types of assets. Can I follow SLM for plant machinery? Can I follow WDV for furniture? Yes, it is permitted. Depreciation when WDV is 5%. Now they have given a concept of residual value. So if I choose to have a residual value of 5%, till 5% I have to provide. Once it comes to 5%, I need not provide further. Again, this is a big challenge when it comes to our existing assets. I may have certain existing assets which have remaining useful life, but the residual value has come down below 5%. I need not reinstate it back to 5%, but then I have to stop charging depreciation. So when we will prepare our Excel sheet or when we will use some software to calculate depreciation, all these things have to be kept in mind. Depreciation, whether assets used or not. Depreciation arises out of technological obsolescence, efflux of time. So irrespective whether the asset is used or not, once it is ready for use, then depreciation has to be charged. There is a strike lockout in the factory. It is continuing since 5-10 years. Whether I need to charge depreciation when there is a strike lockout? Yes, because it arises out of efflux of time. Depreciation in respect of multiple shift working, we have discussed double shift, triple shift. Asset for which no depreciation has been laid down. Under the old law, we had the option under section 205. If for assets no rates of depreciation have been laid down, you could have gone to the ministry and asked for rates of depreciation. Now it is not. Such provision is no longer there. Therefore, what do? We have to fit our assets within the framework of Schedule 2. And if we are unable to fit all our assets within the framework of Schedule 2, what do? We do not have any answer to this. There. It does not fit within what is there in Schedule 2 in any of the line items. Either we possibly fit it. If we are not able to fit it, what we will do? We may resort to that option because Ministry has said that you can have a life which is higher or lower, which is different from what is there. If nothing is provided, we seek technical advice and charge depreciation. That should be the most logical answer to that. Determination of specified period, multiple shift. Can depreciation be provided on unit of production method? Earlier, under Schedule 14, they said that you could charge depreciation on SLM, and as A6 used to say, you can charge depreciation by SLM method, WDV method, or unit of production. What is unit of production method? You can depreciate your assets over the expected number of units an asset can produce. Say, I have acquired an asset for 1 crore. It is assumed to produce 10 lakh pieces over its useful life. So rate per piece, depreciation rate per piece comes to 10 rupees. So in year 1 it produced 1 lakh pieces, it will be 10 lakhs. Year 2 it produces 20,000 pieces, it will be 2 lakh. Year 3 it produces 3,000 pieces, it will be 30,000 and so on. Ministry said no. This goes against the fundamental principle of Schedule 14 that whatever rates are there in Schedule 14 are to be considered as minimum rates. So therefore this method is not workable in the context of this law. So therefore Ministry issued a clarification that unit of production method cannot be applied because in years where we have less production or nil production, depreciation is not provided to the extent the minimum specified in Schedule 14. So this method is not working. God knows how this method will work in this law. Even because the fundamental concept of depreciation is that it arises out of efflux of time. If we have no production and we choose to follow unit of production method and do not depreciate anything, are we not violating the basic meaning of depreciation? Again, time will tell, Ministry will provide answer to this. So we have discussed all this useful life and all. So this is a table of the, we have prepared a table of the useful life. I have given copy of the presentation to the Institute for Circulation also. So we can have all these rates. So if we see the rates, and the useful life, we have derived the rates and SLM and WDV method through some calculations. If we see the useful life has come down substantially. 21 to 15 years, 15 to 10 years, 6 to 3 years, so on. Useful life in most of the assets, you will find it has come down substantially. So, if the useful life has come down substantially, then we have to charge higher rate of depreciation. So, coming year, FY 14, 15, 15, 16 and so on, the rates of the charge of depreciation to the financial statements will be very high. Just see continuous process plan. Under the old law, it was 18 years. When the notification was first issued, I have purposely written 8 of 25. When the notification was first issued, it was 20. It was written at 8 years. Immediately there was a hue and cry from the industry. What you have done? You have reduced the life from 18 years to 8 years. There will be an abnormal charge of depreciation to my PL account. You mean to say after 8 years, my assets do not have any useful life? Immediately, within a span of 4 or 5 days, Ministry corrected this anomaly and they increased the life from 8 to 25. This means when they issued it for 8 years, they did not thought it. They did not think. And immediately not 8 from 9 or 10 or 11, straight from 8 to 25 years.
Now it's 25.
Now finally, as it stands now, it is 25.
60 years.
For?
60 years.
For? No, this is basically, they have also dealt with roads under build, operate and transfer model. Intangible assets, they have stated that intangible assets will be as per schedule AS 26, but only for roads under build, operate, lease and transfer model they have provided these. And this is for 3 categories. Roads also they have given certain categories, and for those it is 10, 5 and 3. Again for roads, for your intangible assets, that what is your toll roads, tolls under build, operate, lease and transfer model, they have prescribed a formula as to how will you amortize. We will come to that also. So under this new law, there was certain doubts initially that after the schedule 2 coming into effect, you can charge depreciation only under straight line method. A view was expressed by many of us, but no. Under this new law, accounting standard 6 is still there. We can have the option of charging depreciation both by WDV method as well as by SLM method. So when it comes to WDV method or SLM method, how do we calculate? We have given an empirical formula. When it comes to straight line, it will be the cost of asset less estimated residual value divided by the estimated useful life for the new assets. And for WDV, it will be the 1 minus nth root of estimated residual value by capitalized cost. So this is the formula. You can use this formula in Excel and calculate the rate. And in respect of assets which have been acquired prior to 1st April 2014, the capitalized cost will be replaced by written down value method. So if I have an asset, say computers, the example which we discussed, 1 crore, 16 lakhs is the year 1 depreciation, 84 lakhs is depreciated. So it will be 84 lakhs minus 5 lakhs divided by 2. That is how we will calculate. So these are the rates. First year, we have to charge depreciation both under the old law and the new law. Because now we are revising our estimate of charging depreciation. So earlier I had followed certain rates. Now I am following useful life, and based on the useful life I am calculating depreciation. So first year I have to calculate depreciation both under the old law as well as new law. And then I have to give an impact of due to change in accordance with schedule 2. What is the impact of the change on my financial statements? Impact on profits, impact on depreciation, impact on net fixed assets. We need to give an impact. So under this new law, if we talk in the profit loss item, if we choose to exercise the option of charging it to PL, that adjustment under transitional provision, there will be a line item for that. If we choose to charge to retained earnings, in the retained earnings there will be a line item for that. Then we have to give a note in the financial statements giving details of what we have done under transitional provisions, what we have done under the new method, and what is the impact on profit and loss. There will be a change in accounting policy as well. And the biggest change will be not replacing Schedule 14 with Schedule 2. The biggest change will be on case of revaluation. That if you have revalued the asset, you have now, instead of recouping the amount from revaluation reserve, it is entirely charged to profit and loss account. There is a big difference. Then we have a depreciation chart. We have original cost, addition, deduction, total. Then under depreciation, we have depreciation up to 31st March 2014, depreciation for the year, adjustment during the year, then adjustment under transitional provisions. We can club those two adjustment columns together. You may have an option of a separate column also for adjustment and a transitional provision. So all those disclosures we must give in the financial statement. But no, next year it's not required. But what is the big challenge? For assets which have been acquired after 1st April 2014, no problem, we can apply the rates. But what about assets which have been acquired prior to 1st April 2014? For those, we have to calculate depreciation for each of the assets. And we have calculated ourselves. If you have 1000 assets, you may have 1000 rates of depreciation. Because for each asset, you will have a different rate of depreciation. If particularly, if you are following WDV method, even SLM method also, but in both methods, you will have as many rates as you have the number of assets. This is the biggest challenge. And the challenge does not end here. These rates will have to be carried by you over the next n number of years till those assets are not fully depreciated. Say, I have 10 machinery. Some has useful life of, remaining useful life of 6 years, some has 5 years, some has 4 years, 3 months. For each of the assets, I have calculated a separate rate of depreciation. 13.9, it may be 22%, it may be 27%, it may be 29%. So those rates are to be applied to those assets not only for FY 14-15 but till the asset is fully depreciated. So that is a big challenge. So initially, first year, yes, we have some issues, but important we have to devote substantial time for calculation. We have to prepare Excel sheets, or if we have some software, we have to do this. But once we do it in 1 year, perhaps your clients will not be able to do. I still see when Schedule 6 came, we have secured loan. We break this secured, say I have a term loan from IDBI. The balance is 1 crore 20 lakhs. I break this amount 1 crore 20 lakhs and show at 5-4 places. Some in long-term borrowings, some in current maturity, some in interest accrued and due, some in interest accrued but not due. Even the best chartered accountant, practicing chartered accountants, they say, अरे आप ये इसको क्या कर दिए, मेरा IDBI का बैलेंस कहाँ चला गया, वो तो कहीं दिख ही नहीं रहा मुझे फाइनेंशियल स्टेटमेंट में. आप you send your auditors to at least help me pass closing entries और वो opening entry को टालने में थोड़ा help कर दो. I am talking of small and medium sized companies. Maybe large companies they have competent people, but SME में बहुत बड़ा problem. Then depreciation. Many of us who are dealing with clients, they are not bothered. Depreciation तो आपका subject है, मेरा तो subject नहीं है. Now you charge, you prepare the register. आप जैसे calculate करते थे वैसे कीजिए. पहले तो आपने कभी depreciation के बारे में बोला नहीं. अभी हम बोलेंगे अरे बाप रे schedule 2 आ गया, बहुत बड़ा calculation है. It must be rewarded. आपको जैसे करना है कर लीजिए. I am not bothered. आपको schedule 2 लगाना है, schedule 14 लगाना है, schedule 9 लगाना है, जो schedule लगाना है लगा. You charge depreciation and so, but you have to explain to the client. And I tell you now, audit is a very, very serious profession. Sir, whatever we have been doing all along, we cannot stick to that and continue in the future. We have to be very, very careful because now number of people are looking upon us. I am a member of QRB, Quality Review Board, impaneled with, not a member, impaneled with Quality Review Board. Then also the impaneled with FRRB, Financial Review Reporting Board. They send financial statements to us for review. We review those financial statements and give our observations. And based on our observations, the institute as well as the NCA takes actions both against the company and the statutory auditors. Quality Review Board, the review process is very elaborate. Say you have audited a company. Ministry says, the Quality Review Board says that the gentleman audited this company, now you go to his place, stay there for 5-6 days and see whether the financial statements which he has prepared is in accordance with the applicable regulatory framework, the Schedule 6, accounting standards, companies as blah blah blah. Plus whether he has complied with the auditing standard. Plus whether he has complied with the SQC, standards on quality control. And we have to give a very elaborate report. They have themselves set out the questionnaire and we have to seek a reply from the members to the questionnaire, and again we have to visit and ensure whatever he has written whether it is correct or not. They give us the copy of the financial statements. We have to review the financial statements and give our observation. It goes to the Quality Review Board. Quality Review Board sends a copy to the institute, a copy to the RBI, a copy to SEBI, because it has in its panel the board comprises of members from CBDT, from SEBI, from RBI, from NCA, from our institute. So number of people are sent there, and if there are anomalies, then you are subjected to action. And FRRB picks and chooses financial statements. Now MCA will pick and choose financial statement for scrutiny. And if you have drawn financial statements which are not in accordance with regulatory framework, now fines or penalties are cash in hand as certified. It is a very common mistake. We write, and when we write, we say, what is the problem? Cash in hand as certified. Inventories as taken, valued and certified by the management. It is not correct. You should not write. Institute has given a guidance. You cannot write cash in hand as certified. You cannot write inventories as taken, valued and certified by the management. Why? Because Institute says when you are writing this, the users of financial statement will read that you are giving a disclaimer. You are putting in the figures what the management has given to you without applying your mind. So you cannot put it. So audit is now very serious. Accounting policies. We disclose accounting policies. At times accounting policies are not properly drafted. We are doing what is supposed to do. We are doing correctly. But accounting policies are loosely drafted. Some items we have not given accounting policy. Sales includes excise, excludes VAT. That is the accounting policy. Income and expenditure are recognized on accrual basis. That is the only accounting policy. We have substantial income by way of job work. We have substantial income by way of interest, by way of dividend, by way of profit on sale of investment. We have not given any accounting policy for that. Sales. How do we recognize sales? Sales should be recognized when the property in goods transfers from the seller to the buyer and there is no reasonable uncertainty as to its ultimate collection. So policy should be framed in all. That is the biggest challenge. So even while calculating depreciation, client will not be able to calculate. We have prepared asset registers for few of our clients and given to them and asked them, "Bhaiya, but check kar do." They are not able to check. Many of the clients, even with competent people, they are because you will get fees, they will not get fees. और जब आप 200 पन्ना का उनको एसेट रजिस्टर बना के भेजेंगे कि भैया आप चेक कर लो, चेक करेगा नहीं करेगा. So there are two ways to look at it. I look at this corporate law as a big challenge when it comes to auditing profession, but as a big opening for a lot of work to come to professionals. Lot of work to come to professionals. But the challenge again is that if we err, then penalties can be abnormally high. So my fee should be proportionate to the risks I am assuming on behalf of my client. I cannot now certify balance sheet 5,000, 10,000, 15,000. Those days are gone because you will not be able to discharge your duties diligently. When I will come to audit report, time permitting, auditing standards, we have 43 accounting auditing standards including SQC. We all know, even I used to know 29 accounting standards, 30, 31, 32 not mandatory till last few years. I also did not know how many auditing standards are there. 43, and we have to ensure compliance with all. Few of us will know the name of the entire 43 auditing standards, but now these auditing standards are notified under section 143. In the audit report, we have to mention that the company is complying with, that we as auditors are complying with auditing standards when it comes to our audit and assurance services. This is a very, very big challenge. We have to have working papers for that. You cannot prepare working papers post you have conducted the audit. You cannot send external confirmations post you have conducted the audit. You cannot verify inventories, physical verification of inventories. You cannot do post. Something happening 2 years down the line, you say, okay, now I will prepare my entire audit file. You can do a number of things, but can you send external confirmation after 2 years? Can you physically verify inventory and prepare inventory verification sheet, cash verification sheet after 2 years? Possibly not. So we must change the traditional way of doing audit. We cannot do the way audit we have been doing. We must have sufficient backup audit papers, audit program, audit checklist, SQC, compliance, all those proper files, permanent file, current file, all those things in place. Else, audit is no longer now that traditional audit. All regulators are behind you. Reserve Bank is time and again issuing letters. MCA is issuing letters. Institute will issue letters. Then some people have come. We have received some letters from Institute, FRRB board, which I am talking about. FRRB reviewed the financial statements. The member reviewed the financial statements, gave letter from MCA. Institute sent it to MCA. MCA show cause the company. Institute show cause the auditor. These are not big listed companies. They are medium-sized, unlisted companies. So we have to be very, very careful now. Times are different, so we have to be very, very careful. So the query is, sir, assets have been acquired by a company from the firm and the dates of acquisition not known, what should be done? Even today when we chart depreciation, the biggest question is, sir, we have never prepared fixed asset register, but all along we have been stating in the first point of the company's auditor's report order that the company has maintained proper fixed record. That is a challenge. Firm, When assets have been acquired by a company from a firm, take the conversion of a firm to a company, takeover. Firm need not maintain asset register. What you have to do? When I acquire the assets, I have acquired the assets en bloc. Say it is a conversion from a firm to a company under Part 9. So whatever WDV is there, it is acquired en bloc in your books of accounts. Then the best possible way is you get the assets valued. You have acquired X number of assets, say 100 assets for an aggregate consideration of say 50 lakhs. You get this 50 lakhs, apportion to that those assets to see this as a starting point.
So this can be done.
What should be the useful life then?
Limited now for those assets.
No, you cannot, because for companies you cannot do now. You cannot now say that I have not maintained, so now I am doing this. No, because all along you have stated that. Now on what you can revalue the asset, you can devalue the asset which has been previously revalued. What you will say now? You have 20 assets, say, and you do not know the original cost, date of acquisition, year-wise depreciation, WDV of each of the assets. You have a net block of 50 lakhs. What you will do? You will provide valuation to each of the assets. This means you are revaluing the assets. You have the option to revalue, but again you need to know the original cost to create the correct amount in the revaluation result. Huh? One second. You will, yes, if your assets are subject to technical obsolescence, you have the option. If there is an asset, I am not using the asset, it can be discarded, it can be held for sale. So if assets are discarded, assets are held for sale, you have the option to value that asset at lower of book value and market value and show it separately in your financial statement. But you must have details of all those assets. Your question is, I have 100 assets, I do not have the WDV of each asset. Then you have to work it out. And it is not difficult. For 5, 6, 7 years, if you go back, you can always easily calculate. On some assumptions, you can calculate, it is not difficult. Yes, ma'am.
If we have some asset in the investment, we need to charge depreciation.
In my view, yes. In my view, yes. We have a very old MCA circular which says that if assets are acquired for investments, let out to others, they are nothing but fixed assets and depreciation has to be charged. There is a very old MCA circular.
For stock in trade,
No, if assets are held as stock in trade, then we will not provide. Because say we are real estate companies, they need not provide depreciation on stock in trade, because it is stock in trade is what it is, assets held for being sold in the usual course of business. So I have given a difference on the two provisions. So this is over. Now, time permitting, what should we do? Depreciation, audit report or a related party or buyback?
depreciation.
Yeah, please.
There is change in the method of charging depreciation. I was charging depreciation under SLM. Now I have shifted to WD or
Yes.
SLM.
Yes.
Now what I will do, previously suppose I was charging under SLM, I was following Schedule 14.
Hmm.
Now I have to recalculate the WDV as per SLM. Okay. So my effect, my disclosure for change in depreciation due to change in method, but change in useful life, change in method will be calculated as per following my WDV and for the year SLM.
You have been charging depreciation till 31st March 2014 under Schedule 14 on SLM method. Now you want to change from SLM to WDV effective 1st April 2014. What the law says, that if you want to change a method of depreciation from SLM to WDV, it has to be calculated retrospectively since the date of addition. So whatever assets are there in the block, now you calculate, say, from the respective date of addition till 31st March 2014 by using WDV method as per the old rates. So once you have calculated as per the old rates, now what the value is there, then
As per the new.
yeah, right. Now this due to this change in method of depreciation from SLM to WDV till 31st March 2014, you will have certain extra charge or write back. Write back. So that will be disclosed as a separate line item. Yes.
Now, for the chains, whatever for like financial is 1450. But if I would have charged under schedule 14, this is schedule 2. Following this WD, I have to do.
First you will give that I have changed the method of depreciation from SLM to WDV. Effect up till 31st March 2014. This is the impact of change. Now, assuming you had done when schedule 14 was there, then you would have calculated depreciation as per schedule 14, right? Then what you have done, you would have given a disclosure that had I calculated the way I had calculated on SLM, impact on profit will be this much. You have to do the same thing. You will calculate and give the impact till 31st March 2014, because till 31st March 2014 you have only one schedule 14. You don't have schedule 2. Now for the current year, after this you will calculate under WDV as per schedule 14 plus as per schedule 2, then you will give the impact. Your view can be that no, instead of WDV I will calculate as per SLM and give the impact. Once you are changing the method of charging depreciation,
WDV as per 14 and WDV as per 2.
no, sorry. It will be SLM as per 14, SLM as per 14 and WDV as per 2. Because when we will compare what amount of depreciation had I charged. Last year I have charged 5 lakhs on SLM. Now I am shifting to WDV. I will charge 20 lakhs. So I have to give a comparison of these two basic figures. Because had I charged the method I did last year, I am not comparing with this year. I am comparing with last year. So last year I charged on SLM. You can have a residual value less than 5%, no problem. Above 5%. Yes. Less than 5%, no. They have stated that you can keep it less than 5%. So we start with, yeah, please.
As per the company's policy, the company scraps its desktop every 2 years. So the depreciation charge will be higher because the useful life is 3 years. Then also I have to get the technical advice.
They say that you can follow a life. No, you see, scrap is different. It cannot be policy of the company to scrap.
Yeah.
You see, it cannot be the policy.
But I don't use it after 2 years.
Then after 2 years you discard it. You see, this law says that the assets have to be depreciated over useful life. It is something different from what is there. It has to be seeked. You have to seek technical advice. And perhaps you have to seek technical advice that life of computer for the industry in which it is used is only 2 years, because due to technological level, it gets scrapped after 2 years. Yes.
Sir, in most of the cases of assets, depreciation as per Income Tax Act now has come down and the Companies Act has increased. So what happened? The companies which are operating for last 4 to 5 years, they have deferred tax liability which is converted to deferred tax asset now. Is there any exclusion required for this?
No, what was the method of depreciation they were following earlier?
WDV in both areas.
WDV as per?
As per Companies Act,
Huh?
as per Income Tax, it is their WDV method.
Oh, income tax for tax purposes they have been.
Yeah,
So they have been charging depreciation under Schedule 14 as per WDV method.
Yes.
Now they will follow depreciation under Schedule 2 as per WDV method.
Yes.
Due to this, there will be an impact on deferred tax. Yes, there will be no problem.
No, what happened now, the depreciation as per Income Tax Act, as per Companies Act, based on the useful of life, has increased.
Yes,
Then the rate as per Income Tax
correct,
Act.
correct.
So those companies which are operating since last 4 to 5 years,
Yes,
they have deferred tax liabilities in the balance.
yes.
Now it is
It will
deferred
be
tax
converted
assets.
into assets, may be converted into assets.
So that deferred tax asset can be adjusted against deferred tax liabilities.
Yes, yes. You can adjust deferred tax assets against deferred tax. Say, assuming you have an opening balance of deferred tax liability of 60 lakhs.
Yeah.
Say, liability of 60 lakhs. Now, eventually over 1 or 2, 3 years, you may have a deferred tax of asset of 20 lakhs. You can recognize that deferred tax asset of 20 lakhs provided it meets the condition of prudence. As 22 has laid down two conditions. In case of losses, virtual certainty. In case of where you do not have history of carried forward losses, reasonable certainty. So you may have deferred tax asset on, say, fixed assets. You may also have a deferred tax liability on some other item. That is permitted. You can recognize deferred tax assets and carry forward if it meets the concept of reasonable and virtual certainty as far as.
I am asking, is there any special disclosure required for this?
Special, no, why special disclosure? What we are doing as per law, nothing special. So we do with audit report or related parties? Related parties. Related parties. I'll just touch audit report, two things, important things. Then I'll come to related parties. I think we have all seen this. Some important things in Caro for 5 minutes, then we go to related parties. Caro is effective 10th April 2014, although notified later, but effect from 10th April 2014. 10th April 2015. It says that it does not apply to a one-person company, a small company, and a insurance company, banking company, Section 8 company. Section 8 means Section 25 company. Now this small company definition is creating a lot of confusion to many of us. Small company is defined in subsection 85. This has undergone a change, a major change. Small company was defined as a company to mean a company with a paid up capital not exceeding 50 lakhs, but which may extend to an amount not exceeding 5 crores, turnover not exceeding 2 crores as per the last profit and loss account till 20 crores. Such higher amount as may be prescribed which shall not exceed 20 crores. So now the limit is 50 lakhs of capital and 2 crores of turnover. Say I have a company, I give 4-5 situations. I have a company with a paid up, I have a public company with a paid up capital of 1 lakh and turnover of 1 rupee. Is it a small company? Is it a small company? By definition, a small company is a public company, is a private company. A public company is not a small company. First, again, I have a private company with a paid up capital of 1 lakh and a turnover of 1 rupee. Is it a small company? Yes. Yes. And again, what are the circumstances in which it cannot be a small company? It is not a small company if it is a holding company of another company. It is not a small company if it is a subsidiary of another company. So if I have a company with a paid up capital of 1 lakh and turnover of 1 rupee, and if that company happens to be a holding company or a subsidiary company of any other company, it is not a small company. Another situation, I have a company with a paid up capital of 26 lakhs and a turnover of 1 crore. Is it a small company?
Yes.
Excluding this situation?
Yes.
If I say it is not a small company, then what kind of company can it be? I say a company with a capital of 26 lakhs and a turnover of 1 crore is not a small company. It is not a public company, it is not a private company, it is not a public company, it is not a holding, it is not a subsidiary company. Still this company is not a small company. It is a company governed by a special act. Non-banking finance companies are governed by the RBI Act 1934 and NBFCs are not small companies because they are governed by a special act. So if capital is 26 lakhs, turnover is 1 crore, it is still not a small company. Then if it is not a small company, then cash flow statement is mandatory, Caro is mandatory. Another situation, I have a company, it is not a public company, it is not a holding company, it is not a subsidiary company, it is not a company governed by a special act. Capital is 1 lakh, 5 lakh, turnover is 5 lakh. Is it a small company? Yes. Again I say it is not a small company because now this company is a subsidiary of a public company. So a subsidiary of a public company is treated as a public company for the purpose of applicability of the provisions of that. So these few situations we must keep in mind.
So small company is subsidiary of another small company.
If I am a holding or a subsidiary, I am not a small company.
So even if it is private,
Even if it is private. Again not a small company. Yes, one more thing. Yes. Now we come to this clause. Similar clause was there under the old law. Similar clause was there. Tell me what is the big difference. Language is identically, absolutely same what was there in the old law. But I said there is a very big difference. What is there in 2015, what is there in 2003, language is similar, but interpretation is different. And there are certain companies which were earlier exempted from CARO are no longer now exempted from that. Just see. Language is absolutely same, but there is a big difference. Read the word financial institution. Section 2, subsection 39 defines financial institution. Under the old law, financial institution was not defined. Companies Acceptance of Deposit Rules 1975, Rule 2, it stated that NBFC is not a financial institution. Companies Auditors Report Order 2003, Central Government, it stated that NBFC is not a financial institution, drawing a reference from what is there in the Companies Acceptance of Deposit Rules 1975. Now, Steps 2, subsection 39 defines defines a financial institution to include any financial institution defined or notified under the RBI Act 1934 and under Section 45 Clause I, a non-banking finance institution. NBFC is a non-banking finance institution. So now non-banking finance companies fall under the definition of NBFC. So earlier we may have borrowings from Reliance Capital, Tata Finance, or even group NBFCs. If we have borrowings from them, even earlier it was only bank or financial institution. So you used to read bank means scheduled bank, private, public, Grameen, non-Grameen. Financial institution used to construe IDBI, ICICI. So if we did not have borrowings from any of them and we had only borrowings from group companies or from say finance companies, we did not consider it to be bank or institution. So those companies were outside the purview of but now they will come in part. There's a big difference. One more clause. Yes. What I have said, this clause is similar to what was there in 2003. The big difference is now with the definition of the word financial institution. Earlier, NBFCs were not financial institution. Now NBFCs fall within the definition of financial institution. So if we are borrowing from NBFC, which even happens to be a group company, assuming other criteria are met or not met, still if you are borrowing from any group company or NBFC, which happens to be an NBFC exceeding 25 lakhs at any point of time, then CARO will be activated. And when I have talked of two criteria, the company with a capital of equity capital 1 lakh, preference capital 50 lakhs, turnover 1 rupee. Is it a small company? Is it a small company? Why? Turnover is 1 rupee, equity is 1 lakh. Yes. Twin conditions must be specified. Earlier they had used the word or. Small company means a company with capital or turnover. Now the word or has been replaced with and. So if we are not able, if the company does not specify, does not comply with the twin conditions, both capital and turnover must be less than 50 lakhs and 2 crores. Turnover is amply defined. No, sorry, I am talking of this small company. In this there is only one difference as compared to
this is old like this is
this is old.
This is old.
This is exactly the replica of what was there in your old car.
I mean, this is like new car.
This is as per new car, but it is a replica of what was there in the old car. But I am just pointing out that there is a difference between the definition of financial institution. Earlier it used financial institution, now also it used
I
financial
think
institution.
it's a loan criteria is extra added. That's why
No, earlier it was there.
now it's also there.
Yes. Now one big issue, acceptance of public deposits. Public deposit, I think we have dealt in the session. Loan from directors, loan from relatives of directors, loan from shareholders, intercorporate loans, even advance beyond 365 days is a deposit. We have to be very careful. If the company has obtained loan from shareholders, it is a public deposit. Loan from relatives of directors, public deposit. Advance beyond 365 days, public deposit. Installment schemes, those gold schemes. You pay for 11 months, in 12 months you get a gold. public deposits. So we have to be very careful. We have to scrutinize the liability side to see whether the company has accepted any public deposit. We may have certain deposits which the government say whatever deposits are there, file DPP4, pay before 31st March. On 31st March, government has issued a circular stating that loan from shareholders you have issued prior to 1st April, which you have received prior to 1st April 2014 will not be constituted as a public deposit provided it is repaid as per the original terms of the loan and you disclose adequately in the financial statements. Right? All these things we have to be very, very careful. And one last point I will touch upon here is audit report. For audit report, we have SA 700, 705, 706, 720, section 143. So now this audit report is issued under Companies Act. We have to report on the matters contained in section 143 to the extent it requires such reports. SA 700, 705, 706, 720. A clean report, a modified report, modified opinion, clean opinion, modified opinion, which may be an adverse disclaimer or your qualified opinion. Then you have an emphasis of matter, then you have another matter paragraph, depending on situations. These reports which we are giving, these are standards, these were standards of Institute of Chartered Accountants of India. Now these standards are notified under the Companies Act for the purpose of section 143, section 143. So these standards are nothing now but even I can say as a part or prescribed by the law. So if we do not comply with the provisions of standards while preparing our drafting or audit report relating to general purpose financial statements which we prepare for our client, we will be subject to the rigors of penalty and prosecution under the law. So earlier our regulatory body was Institute of Chartered Accountants of India when it comes to audit report for SA 705, 706, 720. Now MCA, Ministry, ROC will write letters to us if we are not preparing the audit reports in accordance with those regulations. Three important points have come. We will discuss just the first point and then we will go to related party. Whether the company has disclosed the effect of the pending litigation on its financial position on the financial statements. What is this? What is a litigation? Anything which you have disputed before a judicial authority or court of law. Income tax, sales tax, wealth tax, excise, customs, come it be any. So, I have disclosed the effect. I have some liabilities on account of excise. I have evaded excise. I have imported some machinery. I have kept it in a category which is, I am saying that it is not subject to import duty. Excise has issued a notice, there is a demand. Section 68, it is very common in Calcutta. Section 68, share capital. There has been addition on account of share capital in your assessment orders. You have gone to appeal. In your balance sheet, you have disclosed contingent liability, income tax disputed in appeal, 5 crores. Is it sufficient disclosure or we need to go beyond that? We have a fallacy in mind that if there is a liability on account, there is a liability or any demand raised by any tax authority and if it is disputed in appeal, we need to show only as contingent liability and matter ends there. No. We have to ascertain and analyze whether the liability needs to be provided or not. Say there has been an addition on account of disallowance of certain expenses or income tax has levied tax on certain income. We need to analyze whether within the regulatory framework, within the framework of tax, whether based on past judicial decisions or not, these demands are likely to be crystallized or these demands are likely not to be sustained. We need, as auditors, we need to analyze that to come to the conclusion whether this demand needs to be provided in the books or not. Mere filing of appeal does not mean that we just give a disclosure, contingent liability disputed in appeal and we are absolved. Tomorrow it may so happen that these liabilities may crystallize into actual liabilities and distort the financial statements. Company has taken loan from bank of say 100 crores, there is a liability of 10 crores, contingent liability. On the face of it we can conclude that no, this liability is going to be crystallized into an actual liability. Management does not have any reasonable chance of winning the case. We did not provide for the liability. Management gives a disclosure, contingent liability disputed in appeal. After 4 years, decision has come, you have to pay 10 crores tax, interest, penalty, balance sheet gone. Then it does not pay to the bank, it does not pay to the creditors, who will be responsible? Now we have the even banks, creditors, everybody has the option of filing class action suits against chartered accountants. So just by disclosing it will not be sufficient. So how should we ideally disclose? First, let us analyze whether these demands are likely to be crystallized into actual liabilities. We may insist upon the client to produce legal opinions. Then if the legal opinions are produced and we are satisfied, then okay, we need not provide. But even if we do not provide, what disclosure should we give? We should give the full disclosure. If they are material in nature, we should give a full disclosure of the facts of the case. We should disclose that the company has preferred an appeal based on legal opinion, based on judicial decisions. It is likely that the impact of these demands shall not have any material adverse effect on the financial position of the company. This is very necessary. Just giving disclosure, contingent liability, it will not do. And we have to, when it comes to contingent liability, earlier we were very soft. Management gives all the papers. These are the demand, these are the appeal papers, so much 10 line items, 20 line items we write without even examining whether they are contingent liabilities or they are likely to be crystallized into actual liabilities. So this is very, very important. And last 2 points, 143 F and H. Institute of Chartered Accountants of India has issued a guidance note. We have to also report on matters, observations or comments on the auditor on the financial transaction or matters which have an adverse effect on functioning of the company. This is very important point. F and H, any qualification, reservation or adverse mark relating to maintenance of accounts and matters thereto. These are two very, very important points. We must see the guidance note, the 12-page guidance note issued by our institute on these 2 points. We must see these 2 guidance notes. We are required to report on these 2 points only if we have something to say. If there is a qualification in audit report, it may come in the basis for qualified opinion paragraph, it may come in clause S and clause H as well. If the company has valued inventories at cost instead of lower in cost and net realizable value, it will be a qualified opinion. We will give a qualification if it is material, and also in paragraph F and H we will reproduce, we will give reference to that qualification as well. So these are 2 very important items. And internal financial controls, we are very fortunate that this year it has been deferred for 1 year. Next year it is applicable for listed companies. Now effective 1st April 2015, it is already, this clause is already applicable for the time being. Unless it is deferred for 1 more year, Institute had issued a 270-page guidance note on this one particular clause. On this one particular clause, Institute had issued a 270-page guidance note. Our chairman, past chairman is there, you can ask him. Then immediately, Institute referred this matter to the ministry that this will create havoc. What you are talking of? You are talking of reporting on adequate internal financial controls in place. Even it has been borrowed from US, and even US says that Sarbanes-Oxley Act, you have to report only on internal financial control over financial reporting. Now you intend to cover everything, and when we will report on this, there will be a separate annexure as a part of our audit report. We cannot just write one line item, the company is operating adequate internal financial controls in system. No, there is a separate annexure to this report. Guidance note has it. Next year when it will be effective, we will all deliberate upon that. We will come to know about that. For the time being I am leaving, but this is a very, very important clause. Fortunately it is not there, but companies in their financial, in the director's report have to disclose this. So listed companies where there are independent directors, they are in deep trouble. First, now they have to certify. In the director responsibility this year, they have to certify it. So, section 134, they have to give a statement in the director report. Now they say, unless it is verified, vetted by the auditors, how it can be paid. So many large listed companies have already put these systems in place and get it audited by internal auditors. So now with this, we come to the last related parties. If you have any questions on related parties, you can ask me. Or any questions on the topic we are discussing, or any other question, yeah, please.
If something in emphasis of matter paragraph,
Yes.
we have to specifically write, our opinion is not qualified or
Modified.
But the qualified word has to be replaced by modified.
You see, what is qualification? A qualification You say important is, it is not qualification, it is modification to the auditor's report. A modification to the auditor's report may be a qualified opinion, may be an adverse opinion, may be a disclaimer of opinion. So that is why we write our report is not modified in respect of this matter. And if you have given a qualification which was given last year also, then you have also to say our report was similarly modified in the last year. Say today year 1 I gave a qualification, year 2 also I give that same qualification. Say, then I have to say that my report was yes.
Suppose I give the qualified opinion, along with that, for one matter I am giving emphasis of matter.
Right.
So this will be basis of qualified opinion, then emphasis of
Basis of qualified opinion, then emphasis of matter. Then report.
And in this emphasis of matter,
Hmm.
I have to mention that my opinion is not modified in this regard.
Our opinion is not modified in respect of this matter.
In respect of this.
If you see SS 705, 706, they have given example and they have clearly stated with the example, our report is not modified in respect of this matter.
What is the difference between this transfer to investor protection fund, what we disclose in audit report vis-a-vis CARO?
Vis-a-vis
CARO.
investor,
Transfer of funds to investor protection fund. Both the places we have to disclose, no?
one.
The last point in audit.
Yeah, I got it. Whether the amount required to be transferred to investor and education fund has been transferred within time. Okay. Whether there has been any delay. I don't think. Almost all the same.
Why do we need
You see, even in this A, initially we debated what is the need of clause A. Whether the company is bound to do this. Why do we? So they are not sure whether auditors are doing it. So that is why they have asked you to report. They are not sure. Because AS 29 specifically says the circumstances in which a provision will be treated as a provision and you have to provide for it. If I provide for it, if I disclose as AS 29 contingent liability and even a movement of provision, why do I need to say this? Assuming company did not do, would we not have qualified
that
in the
is what I say. Yes.
under accounting standards that
In
comes?
this opinion, this has to be made a provision. It should not be shown as a contingent liability. I would have qualified my opinion.
Yes. So what is the need? This means ministry is not sure that auditors are doing this. Through this, ministry is trying to impress upon us that you as auditors are not performing your duties diligently. That is why I have made a specific point to open your eyes to you to make sure that you perform your duties. Else, what will be the meaning?
It was the same, no, when we used to disclose the disputed amount.
No, that disputed is different. That is a disclosure. That you have to just.
That is a statement.
That is a statement. That is a fact which you have to reproduce. But here is whether if I am following AS 29, if the company is following AS 29 doing disclosures, do I need to report anything? I will just draw attention that yes, the company has disclosed the effect of pending litigation, refer note number such and such. Correct? Assuming this clause were not there, what we would have done? If the company has done its duties diligently, then it is okay. If the company does not disclose contingent liability, does not make provision, we will qualify our audit report. But through this, two things. First, they are not sure whether we are doing. Second, they want to specifically invite through our audit report attention of the stakeholders to the financial statements. Because they felt that these things are fundamental to the user's understanding of financial statements. This is not a qualification. They could have even stated, we could have also disclosed it is material and we think that we should draw attention to the shareholders, stakeholders. We can also do through our emphasis of matter paragraph or other matter paragraph. We can do this. See, large number of cases are there where 68 additions are made. Many of us are seeking legal opinion, disclosing that under contingent liability, the facts of the case, the legal opinion, the impact if any. We are also drawing a reference to this point. We are also drawing a reference to emphasis of matter to be on the safer side, because what has happened now, I have a balance sheet size of 10 crores, net worth of 10 crores, I have a liability of 4 crores. God willing or God unwilling, if this demand is crystallized into an actual liability, then the company is finished. So we have to be very, very careful. and you should impress upon clients, if I am able to disclose it at two places, what is the harm? Your demand, your case is not affected by I stating this in the audit report. But if something wrong goes, then we are wrong. Because see, under money laundering laws are very strict. As auditors, we always choose to ignore those laws. Even we have to fully see the identity. If I have client as corporate shareholding, I cannot bluntly prepare the balance sheet without going into the details as who are the beneficial owners. Your quality control standard says you must know the identity of the client. I have only 4 corporate shareholders. I prepared the balance sheet without looking into who are ultimate beneficial owners. Ultimate beneficiary will be individuals or group of individuals. Companies cannot be the ultimate beneficiary. I must know even the ultimate beneficiary. And many of these companies, the stakeholders who, if you go down the line chain, you will not be able to find any of the real beneficiaries. What we call the real individuals or a group of individual stakeholders.
The last question, please. Nowadays, any observation or qualification is not to be given in italics or in the bold letters.
Right.
What do you think is the logic behind that?
It has been removed. Earlier it was strict.
It has been removed. So basically,
Because we have a separate paragraph, basis for qualified opinion. Earlier we used to write, in our opinion, see this SA 705 is I think it is only 3 years old. Earlier when we used to give an audit report, that was an old format. So qualified opinion we used to write, in our opinion, and to the best of information according to the set account subject to blah blah blah.
suppose I have got all the information except for one information, which I think is material, but it is not so material that I would have qualified my opinion. Then I used to write that I have sought and received all this information except this.
No, we used to write, we have obtained. We have sought is this year.
I have sought this.
Yes.
So it was in italics or in bold letters, then it would have been eye-catching.
No, but we have a separate paragraph for basis for qualified opinion. Oh, I mean to say you, if you had written there, that we have obtained all information except this.
Yes. So
Okay.
for except this, I would have written in italics. I used to do this. Okay.
Ma'am, there are many things in the law. If we have to understand, we have to read the mind of the ministry. There are many things in the law.
First, that was the system of reading the audit report. What is the qualification?
When we read the definition of small company, there was a lot of ambiguity. Even Institute of Company Secretary has issued an FAQ on this as to what is a small company. There are a lot of confusions. Nobody could believe earlier that a company with a capital of 1 lakh and turnover of 1000 crores can be a small company. But by definition it has been. So when we advise our client, we said there is some drafting error. Please do not understand what ministry. So we have to understand their intention, what is in their mind also in analyzing and interpreting the law. Now coming to related parties. This is one particular section in the corporate law which is giving nightmare to large listed companies and particularly those that subsidiaries. We are concerned with loan from shareholders section 185, 186. It is giving nightmares to us, our clients. But listed companies, large listed companies, it is section 188 which is giving nightmare to them. OECD, there is a OECD, India is a member of OECD. Around 2012, it had published a report on these related party transactions. And it has commented heavily on abuse of related party transactions by corporates. In its research report, it stated that those companies which have large related party transactions have shown lesser profits than the companies which are subjected to minimum related party transactions within the same years. So abuse of related party transactions is across the globe and it is a cause of concern to everybody. It is a cause of concern to minority shareholders, it is a cause of concern to independent directors, it is a cause of concern to all regulators, taxation authorities, because related party transactions somewhere or the other in the law you will find everywhere. In income tax we have related party concept, 222E, section 11, 56, section 80C, lot of places we have relatives and related party concepts. In Companies Act also we have related party concept. Earlier in accounting standard, companies accounting standard rules we have related party. There is no harmonization between all of them. A relative may be a relative for the purpose of 222E, for the purpose of section 11 or for the purpose of 56. It may not be a relative for the purpose of, even for the purpose of 222E, what is a relative is not the same as what is there for the purpose of 56 or for that matter section 80C. So definition of relative also for different sections are different. So not to talk about the different regulations, even for different sections are different. And very surprisingly, related party transaction, they have defined related party under 2 subsection 76. They have defined relative under section 2 subsection 77. So this is related party. This is definition of relative for related party also. But when it comes to accounting standard AS 18, which you will see, the definition of relative is different. Both are related party. One is what you call your compliance framework, that you have to comply with this provision. Accounting standard 18 is your disclosure provision. You have to disclose all these related party transactions. So, related party just touch upon some important crucial issues. Character or relative. So who is a relative? They have defined the relative. Relative means members of HUF, husband, wife, then father, mother, son, daughter, daughter's husband, brother, stepdaughter, sister. They have included step relationship. Have you seen step relationship included under Schedule A? Schedule 1A under the old Act? Was step relationship included? Has step relationship been included in the definition of relative in income tax? Has step relationship been included in the definition of relatives under accounting standard AS 18? Does it mean that you by prescribing specifically as to these are step relationships are also relative, you mean to say where I have not prescribed step relationships are not relative? So obviously we cannot have that interpretation. We cannot read the mind of the legislature as to why they have written. Even we were otherwise included step relationship also for the purpose of relatives. Members of HUF. Those who have HUF, do they know who are my relatives? Do I know who are whom? If I am a member of Hindu undivided family, do I know who all are my relatives? I have a grandfather, he had 3 children. Each of us has 2 or 3 children. Now even female are members of HUF. Do I have all the information on who are members? There is a difference between member and a co-partner. Member is very long, co-partner is a restrictive list. Still do I know? And for that matter, what they have stated. Who is a related party? A firm in which director, manager or his relative is a partner. Do I have the data of where all my relatives are partners? Do I have the data? Then how do I disclose? How do I disclose? How, if the company enters into transaction with this party and say there is some wrongdoing, I am also not knowing that the company has entered into a transaction with this firm in which my relative is partner. Am I under obligation? I am under obligation to disclose that I am interested in this transaction, but I myself do not know. Is my relative under obligation to disclose to me that he is director, partner, member, firm of such and such firm or company? How do I disclose?
So even for brother, it may be.
Yes, brother. Will your brother tell you in which companies he is holding shares, in which companies he is director or partner? Will he tell you?
Sir, what is the definition of step brother?
I do not know the definition of step brother, but logically it should be a step brother is one, a father having 2 wives. So it's a